company and are required to generate revenue. Therefore, costs which represent personal expenses for the owner are not deductible or not approved by the law. But some cases, there are called common expenses. What is the meaning of common expenses? These expenses are used by both the company and the owner. For example, using the car for both the company and the owner. The law stated that 2/3 or 2/3 of the common expenses will be considered related to the company and then considered as a deductible cost, and the third will be considered as a personal expenses and then will not be considered as a cost. The second and the most important condition is actual, not expected. This means the costs have already occurred, whether they have been paid or are still due. If it is probable to occur, it will not be deducted. So any expenses likely to occur in the future are not deductible, like reserves and allowance. The third condition is related to the tax fiscal year. This condition is an application of the accrual basis. According to this base, all expenses related to the taxable year shall be deducted regardless of the payment. Also, the expenses paid by the company in 1 year that is related to the previous or the next year are not considered to be costs. The principle of independence of the tax year. The fourth condition, that expenses should be revenue expenditure, not capital. What is the meaning of revenue expenditure? They are deductible costs according to the registrator. They are expenses paid by the company in order to practice its activity, and they are characterized by periodicity and small financial value. While capital expenditure are not deductible costs. Why they are not deductible as costs? These expenses are paid by the company to increase its production capacity, like purchasing a new asset, building a new factory. It is characterized by a large financial value and a large interval between each purchase. And the company benefit from these expenses for a long period. These expenses will be distributed over the years of benefit. The value distributed is considered as a revenue expenditure. The last and the final condition is these expenses should be supported by documents. As mentioned before, the general rule is every expenses must be supported by document, like a receipt or an invoice, in order to be considered as a deductible cost. But there are some expenses that are customarily not supported by documents due to its nature. These expenses, which are not supported by documents according to its nature and approved by the law, are the following: internal transportation expenses, buffet expenses only for customers, cleaning expenses, stamps, and gratuities. According to the law, these costs are deductible provided that they do not exceed 7%. What does it mean it doesn't exceed the 7%? The maximum level of approval is 7%. Whatever exceeds the 7% will be considered as a non-deductible cost. So again, according to the law, these costs are deductible provided they don't exceed 7% of what? Of the total general and administration expenses supported by documents. How to calculate the general and administration expenses? According to the law, general and administration expenses include all expenses except fixed asset depreciation, reserve and provision, losses from securities, losses from revaluation of foreign currency, losses from revaluation investments. After fulfilling all the above conditions, the legislature stated that costs deductible by law are needed to be subtracted from the total taxable revenue in order to reach what we call it the TMB. The first and the most important type of expenses for juridical person is debt return on loan. What is the meaning of debt return on loans? In certain cases, a company may borrow money from others in order to perform its activity. Return, which is another meaning of interest. Interest paid against these loans are called debt return. So again, debt return means what? The interest which is paid for the loans taken by the company. Again, we differentiate between the loan itself and the interest paid for these loans. The interest paid is called debt return. Here we are focusing on what? Not on the loan, we are focusing on the interest. So we are going to call it debt return. They are considered, as a general rule, debt return are considered as deductible cost and it is approved by the government. But in some cases, they are not approved. What are the cases for not deductible cost? These are 4 cases. Case number 1, debt return for loans taken from a non-taxable natural person or exempted from it. So it is very logical. If I'm taking a loan from a natural person or from an exempted person, the debt or the interest paid for these loans are not deductible, not approved by tax. The second case of non-deductible cost is the debt return for loans exceeding, which means more than, twice the credit, or sometimes we call it discount rate. This discount rate is declared every year by the central bank. The third case, debt return or interest on loans shouldn't exceed 4 times the actual the actual ratio of average loans and debt to the average owner's equity. We are going to discuss the third case in details later. The fourth case is the debt return for loans not used for performing the activity, like the loans taken by the owner for her personal use. There is another expression which is opposite to the debt return. We call it credit return. It is very obvious. It is opposite to debt return. So it is not money paid, it is money received. So what is the meaning of credit return? It is received by the company from others. Must be deducted from the debt return. So we have to calculate the debt return first and then deduct the credit return. Whether these credit returns are not subject to the tax from exempted person or not. Credit returns are include all the amounts received by the company, like investment in loans, advances, all kinds of debt, bonds, treasury bills, and so on. The legislature stated that the financial institutions like banks, insurance companies shall not apply the above conditions. Why they are not applying these above conditions? Because the nature of their activity is in dealing with interest. So we are dealing with commercial and industrial only. Let's go back to the third case for non-deductible cost. Again, what is the third case? If the debt return exceeds 4 times what? What we call it the actual ratio. So how to calculate the actual ratio? The legislature stated that there are 4 steps. It's very, very, very important. Please focus. 4 steps to calculate the actual ratio. Step number 1, we have to calculate what we call the average loan. The expression average means I have to calculate the beginning loans and then add the ending loans. The result will be divided by 2. So again, what's step number 1? I need to calculate average loan. How to calculate average loan? It's beginning loans plus the ending loans divided by 2. The second step, calculating average owner's equity. Again, average means adding beginning owner's equity plus ending owner's equity and then dividing the result over 2. So, how many steps do we have? We have 2 steps. Step number 1, we have average loan. Step number 2, we have average owner's equity. Step 3 is very easy. How to calculate the actual ratio? We have to get result number 1 and divided by result number 2. So I'm going to divide average loan divided by average owner's equity. The result is called actual ratio. The last step, how to calculate the non-deductible debt return. Again, what is the meaning of non-deductible debt return? It means the non-approved, the part that is not approved by the tax. In order to calculate the non-deductible debt return, we have to apply the equation. Equation equal to what? The debt return paid, the amount actually paid, multiplied by AR. AR here means the actual ratio, which is step number 3, minus 4. What is 4 here? According to the law, it shouldn't exceed 4. So 4 here is the maximum limit. So AR, the actual ratio, minus the 4 divided by the actual ratio. Let's apply these rules. Total loans received by the company during 2017 were 1 million. So here he is telling me loans received, not paid. Total loans received by the company during the year were 1 million. These loans were used for the company activity. The total debt return paid, again he's telling me paid, total debt return paid during the year were 200,000. The credit rate declared by the central bank was 9%. Revenues for 2017 included amount of 30,000 return from Egyptian bonds. Required, calculate the approved deductible debt return. Here he's asking about the approved part, not the non-approved. So I'm going to focus my calculation on the approved part. How to calculate the approved part? Let's start from the beginning. How much did the company paid for the debt? The company paid, according to the given, the company paid 200,000 debt. Okay, what is the maximum amount approved? According to the law, the maximum approved is twice the credit rate. Let's go back to the given. How much loan did I take? I took 1 million. Approved twice the credit rate. According to the given, the credit rate is 9. So 9 multiplied to equal 18. The maximum limit is twice the credit rate. Again, 9 times 2 equal 18. The maximum limit is 18%. So 1 million multiply 18%. So the maximum approved amount is 180. I actually paid 200, but the approved amount is 180. Remember, I have to deduct the credit return. According to the given, 30,000 is considered as credit return. So the net debt return approved by the government will be equal to 180. Again, the government will not approve the 200, the government will approve the 180. So I need to deduct 30,000, the 150,000 will be considered as the approved part. Let's see another example. The total debt return, again, what is the meaning of debt return? Debt return means interest on loans charged in. What's the meaning of charged in? Charged in means recorded in the income statement. How much did the company paid during the year? The company paid 3 million. 3 million again are not the loan. These amounts are the interest, just the interest. If you know that total loans received during the year were 20 million. What is the detail of the 20 million? 4 million from exempted natural person at a rate of 10%. 12 million from Masr Bank at a rate of 15% annual. 4 million from National Bank at the rate of 20%. So my company took loan for 20 million, not from one source, from 3 different sources. According to the given, the credit rate declared by the central bank was 9%. Revenue for the year include an amount of 900 returned from banks. This amount is returned from banks. Calculate both the non-deductible and the deductible. Here he's asking me to calculate both the approved part and the non-approved part. Let's start from the beginning. Let's start with the non-deductible part. According to the law, there are 2 ways to calculate the non-approved. Let's start with the return on the loan from exempted person. According to the law, the non-approved is the amount related to the exempted person. According to the given, the company took 4 million from an exempted person at a rate of 10%. So I'm going to multiply 4 million multiply 10% will give me 400. This amount is considered approved? No, it is not approved. Again, why it is not approved? Because it is interest paid from an exempted person. The second case for the non-approval, if the loan exceeded twice the credit rate. According to the given, the credit rate declared by the central bank is 9%. So again, 9 multiplied to 18%. The maximum limit is 18%. What about the Masr Bank? National Bank, the interest is 20%. So 20% exceeded the 18%. So how much is the difference? 2%. So 2% multiplied 4 million will give me 80,000. So how much is the amount of the non-approved? The non-approved equal 480,000. So total non-approved debt return is 480. What about the third case? What is the third case? The approved part. How to calculate the approved part? So the total debt return is 3 million. I have to deduct the non-approved, which is equal to 480. So 3 million minus 480, the total approved debt return is 2,520,000. Remember, I need to deduct the opposite of debt return. What is the opposite of debt return? Credit return. According to the given, the company received 900,000. So I'm going to deduct the total approved 2,520,000 minus 900. The difference is 1,620,000. Let's see another example. A resident company in 2019, the beginning balance for loans 5 million from the Ahli Bank at a rate or interest rate 10.5%. At July, the company took a loan of 15 million from Cairo Bank and interest at a rate of 11%. In October, the company took a loan of 10 million from CIB Bank at a rate of 15%. The total debt return paid, again, the amount paid and recorded in the financial statement were 1,725,000. According to the following, 525,000 were paid to the Ahli Bank loan, 825,000 were paid to the Cairo Bank loan, 375,000 were paid to the CIB Bank loan. The average owner's equity, according to the given, was 2.5 million. The credit rate declared by the central bank was 7%. Calculate the non-deductible debt return. Here he's asking me about which part? He's asking me about the non-deductible part. Again, let's us remind, how many cases for the non-deductible part? Cases of exempted person, any amount exceeding twice the credit rate declared by the central bank, any amount exceeding 4 times the actual ratio. Let's apply the rules. First, debt return exceeding twice the credit rate. The only debt return exceeding twice the credit rate is the CIB Bank. Why? According to the given, the credit is a discount rate declared by the central bank is 7%. The maximum level is twice, so 7 times 2 equal 14. The only bank whose interest is more than 14% is the CIB Bank, whose interest is 15%. So the maximum rate, credit rate multiplied 2 equal 14%. The non-deductible part, the non-approved part is equal to what? 375,000, which is the interest for the CIB, multiplied by the difference between the maximum level and the actual level. The maximum level is 14, the actual level is 15, divided by 15. So 1 over 15 equal 25,000. The 25,000 is which part? The non-approved part. The second rule, any amount exceeding 4 times the actual ratio. Remember, in order to calculate the actual ratio, I have to go through 4 steps. Let's start with step number 1, to calculate the average loan. How to calculate the average loan? Beginning loan plus ending loan divided by 2. According to the given, beginning loan 5 million, ending loan 5 plus 15 plus 10, which is equal to 30 million. So 5 plus 30 equal 35 divided by 2 equals 17.5 million, which is the average loan. Second step, average owner's equity, it is given 2.5 million. The third step, very easy. I have to divide the average loan over the average owner's equity. So 17.5 divided 2.5 equal 7 times. The fourth and the final step, the most important step, exceeding 4 times. According to the given, I actually exceeded the maximum level. Why I actually exceeded? According to my calculation, the company paid actual ratio 7 times. My maximum level is 4. I exceeded by how much? 3. 3 over 7. Let's see how we are going to calculate. The debt return paid, but remember, after deducting the unapproved debt. So the company paid, according to the given, 1,725,000. But remember, there is 25,000 which is not approved from the previous calculation. Multiply by the actual ratio. According to my calculation, the actual ratio is 7 minus 4. Again, what is 4? 4 is the maximum level. So 7 minus 4 divided by 4. What is 4? The actual ratio. So I'm going to multiply 1,700,000 multiply by 3 over 7 will give me 728,571. Again, this amount is what? The non-deductible part. So, according to the given, I have 2 non-deductible part. The 25, which is calculated previously, plus 728,571. The total non-deductible cost is 753,571. The second type of deductible cost is the capitalized debt return. The capitalized debt return, what's the meaning of capitalized debt return? Capitalized debt return means adding the value of interest paid to the book value of the asset. Remember, we discussed this part when we were calculating the selling for fixed assets. The accounting standard allows adding, which means capitalize, the interest to the book value of the asset. The law allowed capitalizing the interest paid to the bank value of fixed assets. From the tax point of view, capitalized debt return is part of the fixed asset and must not be included in the income statement. What is the meaning not included? So, capitalized debt return are not approved as an expense. Remember again, capitalized bad debt are not approved as an expense. The legislature stated two cases concerning the capitalized debt return. Each case has a different tax treatment. The first case is the company took a loan only to acquire an asset. The second case, if the company took a loan for both acquiring an asset and for another activity related to the company. Let's see the tax treatment for the first situation. Company acquire a loan for acquiring asset only. The company took a loan for acquiring an asset only and not for any other reason. Then the value of the debt return, again, what is the meaning of debt return? Interest on loan, will be added. What's the meaning of added? Capitalized to the book value of the asset. If the capitalized value is within the limit stated in the third case, remind me again, what is the third case? If it doesn't exceed 4 times the actual ratio. If the capitalized debt return exceeds the limit, then the exceeded value will be deducted from the book value of the asset, which means non-capitalized, but still not approved as an expense. The non-capitalized value will only decrease the book value of the asset. The new value of the asset will be approved by the tax and will be used later for calculating depreciation. What is the tax treatment for the other situation? What is the other situation? Company acquire loan for acquiring assets and other reasons. If the company took a loan for acquiring an asset and another reason, remember, related to the company activity, then the value of the debt return will be capitalized. Again, what is the meaning of capitalized? Will be added to the debt return. The debt return included in the income statement and will be compared with the limit of the case 3. What case 3? Exceeding 4 times the actual ratio. If the total debt return for both the capitalized and the interest paid exceeds the limit, which is the limit, what is the limit? 4 times the actual ratio, then the exceeded value will be deducted from the book value of the asset, which means non-capitalized. If the part included in the income statement is not enough, the non-capitalized value will only decrease the book value of the asset, and the new value will be approved by the tax, which is going to be used later for calculating depreciation. But if the exceeded value is less than the amount included in the income statement, then the book value of the asset will not be decreased. Let's apply these rules in this example. A resident juridical person took a 50 million loan from a master bank to acquire a factory. Remember, factory is an asset. So, according to the given, the company took loan for just one reason, to acquire an asset. So, this is case number 1. Debt return, what's the meaning of debt return? Interest paid on loan. Paid during the year for this loan was 7.5 million. Remember, according to the given, this amount, what amount? 7.5 million was not recorded in the income statement. The average owner's equity during the year was 10 million. The asset or the factory book value was 60 million, including the interest. Required. Determine the tax treatment for the following cases. I'm going to solve the problem according to separate cases. Case number 1, the company only took the loan for the factory. Case number 2, the company took another loan plus the 50 given before. The company took another loan, 40 million, for another reason. Recorded the interest paid for the loan was 4.5. Let's start with case number 1. The company only took one loan for the... I have to calculate the maximum limit. Again, what is the maximum limit? Exceeding the 4-time level. Step number 1, calculating the average loan. According to the given, the company took just one loan, 50 million. One loan, one average, so I don't need to calculate it. Step number 2, average owner's equity, just one number, 10 million. So the actual ratio will be equal to the average loan divided by the average owner's equity. So 50 divided by 10 equal 5 times. Remember, The maximum level is 4 times. According to this company, the company exceeded the limit. What is the maximum level? 4. Since I exceeded the limit, I need to calculate the non-deductible debt return. Remember how to calculate the non-deductible. Total debt return capitalized according to the given. The 7.5 was capitalized, was added to the asset, multiplied by the actual ratio, which is 5, minus the maximum limit, which is 4, divided by 5, equal to 7.5 million, multiplied by 1 over 5, equal 1.5. What is the tax treatment here? This is case number 1. According to the law, the non-deductible debt return has no effect on the income statement. Still, it will not be approved as an expense. Since it was not recorded, so it is an expense, not recorded, not approved, no adjustment. But what is the effect here? The factory is an asset. The whole value of the debt return was capitalized, so the tax must decrease the value of the factory by the non-deductible part. According to the given, the value of the asset, which is 60 million, must be deducted by 1.5. Why must be deducted? Because the 1.5 million is non-approved. So the approved value of the asset will be equal to 58.5 million. The second case, if the company took more than one loan. According to the given, the company took 2 loans. The first loan 50 and the other loan 40. Again, what is the maximum level? Exceeding 4 times the actual ratio. What are the steps? Step number 1, average loan. Here I have 2 loans, beginning and ending. So 50 plus 40 plus 50 plus 40 divided by 2 will give me 90 million. The average owner's equity, according to the given, I don't have just one number, so the average owner's equity will be equal to 10. Actual ratio equal to average loan divided by average owner's equity, so 90 divided by 10 equal 9 times. It is obvious here that the company exceeded the maximum limit. Again, what is the maximum limit? The maximum limit is 4. How to calculate the non-approved part? Again, how to calculate the non-approved? According to the rule, total debt including 2 parts, the capitalized part and the interest paid. So 7.5, which is the capitalized part for the first loan, plus the 4.5 for the second loan, multiplied by the actual ratio. According to my calculation, it is 9, minus the maximum limit, which is 4, divided by the actual ratio, 9, equal to 12 million, multiplied by 5 over 9, will give me 6.6 million. Again, 6.6 million is which part? The non-deductible debt return. What is the tax treatment? Remember, I'm talking about its effect on both the income statement and the balance sheet. The non-deductible debt return has no effect on both the income statement and the balance sheet. Why has no effect? Because the amount included in the income statement, included again means recorded, 4.5, is considered an expense recorded and not approved. So it must be added to the accounting net profit. The remaining non-deductible cost, which is not included, 6.6 minus the 4.5, 2.1. It will be deducted from the asset. So, according to the given, the value of the asset, 60 million, minus the 2.1, equal to 57.9. This amount will be approved as the book value.